Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Hiran Amin. Did you know there are roughly 1,000 bond exchange traded funds across Canada and the US? Clearly, a lack of choice isn't the issue when it comes to adding fixed income to a portfolio. Instead, the real challenge is analysis paralysis. After all, how can an investor figure out which bond fund might be right for them with so many possibilities? Well, there's a handy decision tree that can help them narrow down the list substantially. So let's walk through it with today's guest speaker. Joining us is Matt Montemurro, portfolio manager at BMO ETFs. Matt, welcome to the show. Thanks for taking the time to chat.
Thanks for having me, Aaron. Looking forward to it.
Yeah, we got a great conversation ahead of us, Matt. So let's get to know you a little bit and what you do. So can you tell us about the work you do with fixed income investments at BMO?
Yeah, absolutely. So at BMO, I lead our passive fixed income portfolio management team. We manage, among other things, our BMO ETF lineup. So we manage about 67 different strategies, 32 billion in AUM, and we're interacting with the bond market on a daily basis. Both Canada and internationally, and we're really trying to provide investors with the outcomes that they expect from their fixed income investments, and that's my job in a nutshell every day.
All right, sounds exciting there. And so tell me about this. Why do you think it's particularly important for investors to be thoughtful in the way that they add fixed income to their portfolios in today's economic environment?
I think a lot of us focus on the equity side of your portfolio. In general, it's more understood. It's definitely more discussed in the news. It's more topical. You have those conversations around the dinner table. But bonds do play an important role from a total portfolio context for investors who are really looking for long-term performance. Especially in today's environment where volatility has spiked to levels we haven't seen in years, and we're seeing bond returns look a lot more like equity returns. So it's important for investors to understand the role that bonds play within your portfolio. And in general, investors should be looking for a few things out of that bond segment of their portfolio: stability, downside protection, and income. And those are the three things that I think the bond side of your portfolio can really provide and help you weather, some of the volatility that we've been experiencing in markets.
All right. Something got my ears perked up is when you said those returns are looking very much like the equity side of the investment world. So I'm eager to hear more about it. So with that, let's get into our conversation for today. Let me start off by asking this. Let's start with some of the basics to get everyone on the same page and up to speed about bonds. So can you fill us in on how they work at a high level?
Yeah, so quite simply, a bond is a loan between an investor, you, and a borrower. Let's say a company or a government. In this case, let's use the government of Canada as an example. They issue a lot of bonds, and so what they're doing is asking investors to lend them money. It's basically an IOU. The investor will earn a set interest rate, which is generally paid twice a year. This is called a coupon, and it's for a set term. So let's say the coupon is 5% and the term is 5 years. So the investor will earn 5% a year for 5 years. And at the end of the 5 years, they will earn their principal or initial investment back. So that coupon, that 5%, how is that derived? Well, it's derived from the prevailing interest rate in the market for a similar term bond or a similar issuer. When a bond is issued, these bonds are issued at par, which is considered $100. So let's remember the coupon is fixed for the entire term of the investment. So that 5%, that is what the investor is going to earn each year for the term of the investment, in this case, 5 years. But interest rates in the market do change. So what happens? So bond prices and interest rates are inversely related. So when rates or interest rates go up, bond prices go down. So as an example, since we saw interest rates go up so significantly last year, a bond would have been issued at 25 basis point coupon. Just a few months later, as interest rates rose, that same issuer, the government of Canada, would then issue a bond at 5%. So that would mean, as an investor, you were only earning 0.25 or 25 basis points with the same credit risk as something that is also earning 5% in the market. So, how does that work? Basically, that bond price has to go down to reflect it. And you're essentially buying this bond at a discount to par. So you're buying it lower than $100 for the same risk because you're earning less per year in coupon than the prevailing interest rate.
Okay, yeah. So it's about, where the money's flowing in terms of where how attractive the yields are. And one thing I just wanted to point out that kind of can get people tripped up is the actual coupon we talk about. The let's talk about the hard dollar value doesn't change necessarily. It's really the yield that is moving in accordance with the relationship with the price. Just so I understand that.
Exactly. Exactly.
That's a good primer there for us. Thanks for shedding some light on there, Matt. And we're going to get more into the interest relationship in a bit as well. What role do bonds typically play in a portfolio then?
So for the most part, I would say bonds generally provide that downside protection in your portfolio. Stocks and bonds generally have a low correlation to each other. So when the equity side of your portfolio is pulling back, the bond side of your portfolio can provide you that downside protection that you want to weather the storm in challenging markets. So while equities are generally used for capital appreciation, bonds can be used as an income source, but also for a downside protection. And that's why, in a portfolio context, you want that two sides of it to make sure that when one is doing well, the other one's pulling back. And when one is pulling back, the other one is keeping you afloat.
So now that we've talked about kind of how individual bonds work, but investors can also purchase bond funds. So what are some potential benefits that bond funds can offer?
Yeah, so bond funds, ETFs, mutual funds have really democratized the environment for retail investors, and the first big benefit is diversification. You get diversification in a single trade, which is a huge benefit of using an ETF versus using a single security or a single bond. So when you buy a bond, you're now taking credit risk of that specific issuer. Again, government of Canada, maybe it's Bell Canada, maybe it's the Bank of Montreal or TD, but you now have specific credit risk for that issuer. With an ETF, you can get exposure to thousands of bonds, hundreds of issuers, eliminating that security specific risk and taking advantage of a diversified market exposure that you really want to drive returns over the long term. In addition to diversification, ETFs really open up investors options when they're trying to get exposure to difficult to access areas of the market. Bonds, in particular, are an over the counter market. So that can make it very difficult for retail investors to get liquidity on a wide number of bonds. So you're basically stuck with the inventory that your bond desk has, and that changes from day to day. You may not have the same inventory today that you'll have tomorrow, and you have the next day. With an ETF, you can have that consistent inventory and specific exposure in a diversified manner. And then outside of those two benefits, ETFs also can provide you very targeted exposure. So I gave the example of thousands of bonds, hundreds of issuers, but you can also pick and choose the risk you want in a very targeted way while still getting diversification. So, for example, if you wanted corporate bond exposure and you only wanted bonds that were 1 to 5 year to maturity, there are ETFs that allow you to pick and choose that exact risk exposure that you want. And you can do it in bonds, but the ETFs give you that diversification, and in a single trade, give you exposure to the entirety of the market. And that really allows retail investors to compete with institutions in the bond world.
Okay, now that we have a better understanding of how bonds work, let's chat through the decision tree that can help investors research bond funds. The first key question is actively managed, a passively managed fund, or a blend of the two? Why is this an important consideration?
Active versus passive. It always comes up. It's like we're always fighting this battle. But again, the way I look at it, it's not an either or proposition. Blending the best aspects of active and passive leads to better outcomes for investors. You have the choice of both. Why just pick one or the other? Pick the one that you think gives you the most value in specific segments of the market And I think each of them have benefits that you can take advantage of them as an investor. If I would consider, I would looking at something like low cost passive ETFs as the core of my portfolio for the efficient or more efficient areas of the market. Look for low cost for efficient areas of the market, and then use active ETFs for maybe less efficient or more difficult to attain segments of the market. Studies have shown that over time, the biggest driver of returns is asset allocation. So utilizing both active and low cost passive within your portfolio can lead to those better returns over time. So, if I'm looking at comparing them, what are some of the factors that I look at? Fees is a big thing. You see it in headlines all the time. Differential alone can be a significant driver of returns. So it's important to understand, what are you paying in terms of fees, and ensure that the active management that you're getting in terms of performance is paying for those fees. And you can generally get that performance if you're looking at the best active managers out there. So there's a spectrum here in terms of differentiating between what product to use. Pure broad-based passive investments in the ETF side, extremely low cost. Investors can kind of set it and forget it if you're very fee conscious. You could use that over the long term. Other ETFs are a little bit more, you can use them as active tools as well. So it's not just active versus passive management, but it's also, you can be active using passive tools like ETFs to pick and choose that's precise and segmented exposure that you want. So, do you want long or short duration exposure? Do you want corporate or government exposure? Do you want investment grade or high yield? These are all active decisions that you as an investor can make using the ETF. And I think by just looking at the market and saying, okay, am I getting returns or getting value from the fees I pay, is often a question that investors can say, okay, yes or no, and that's how you can choose your active or passive path.
Okay. And one question I had on that point that you made, Matt, was is there then single product ETFs that combine both of those together where you have a bit of passive as part of its asset allocation as well as active in there?
There are definitely asset allocation ETFs in the market that combine active management or process driven management with passive building blocks like ETFs. So, for a investors who are looking for a single ETF solution, those asset allocation ETFs can definitely be a tool that they can use as a portfolio building block over the long term.
Okay. All right. So that's a good framework to get us started off there. So that leads us to the second question in the decision tree, and that is, what is the investor's view on the economy? Now, how might this influence the type of bond fund they might want to hold?
Yeah, so I think this second question is important for investors to consider. Your view on the economy, where are we now, but also where are we going? If you ask me right now, in my opinion, I think both central banks, north and south of the border, are firmly in a higher interest rate for longer stance and pattern. I don't think they're going to be in an environment where they're going to hurry to start cutting rates. So that tells me that rate cuts are going to be pushed late into 2024, and we're going to get a little bit of stability here in our interest rate policy. So for me, I think that that's going to lead to us moving to a mild recession. I don't think we're going to get into a 2009 like environment, but I do think it's important, if you think that there's going to be a pullback and these higher rates are going to impact economic activity, it's important to make sure that your fixed income part of your portfolio is there to protect you on the downside. Because again, if we see a pullback in growth, that likely means the equity side of your portfolio is going to pull back. So you want to make sure that you have positioned yourself to perform well. So in this type of environment, you want yourself to have some exposure to different segments of the market. So, that could be, having an aggregate bond ETF that provides you the exposure to the entirety of the universe, some short term, some corporates, some long term government, or you can be a little bit more active in your positioning. And this is where I think right now a barbell like strategy is very appealing. And that means barbell saying, overweighting short term and long term to take advantage of market dynamics. So I would look at something like short term corporate bonds. You're getting over 5% yield with very little duration risk from a risk return perspective, it is a very attractive part of the curve. You're getting a yield that's you haven't seen since the early 2000s, so you're earning more and you're taking less risk. Pretty good trade off in my opinion. But then I would complement that with long duration exposure, specifically government bonds, either Canada or the U.S. So I think a barbell trade, if you're being a little bit more tactical in the market right now, is something that is extremely well positioned. But that's also the benefit of having that aggregate solution. You're having exposure to the entire curve. You'll have a piece of everything during that type of environment.
Yeah, I do like that approach. It takes a little bit of the guessing work out of the picture in terms of figure out where the economy is going, and I think that even stops most economists as well. So, the barbell approach is the one we're going to lean on. All right, let's move on to our third key question in the decision tree then, and that is, how does the investor anticipate benchmark interest rates may change? The yield curve can be a key signal for investors here. So, can you explain to us how it works and why it's so important?
Yeah, so the yield curve is the relationship of interest rates and the maturity of bonds. So it gives you an indication of what the market expects future interest rates to be. So central banks like the Bank of Canada, they will impact the short end of the curve, right? They have the overnight rate in Canada is 5%. So that is going to basically be the short end, right at the end of the curve. And then the rest of the curve is derived by the market's expectation of what rates of different maturities as you go out the curve is going to be. In a normal market, the yield curve is considered upward sloping, meaning shorter term bonds will earn a lower interest rate versus longer term bonds, which intuitively makes complete sense, right? Because, all things being equal, it's more risky to lend money for 5 years than it is to lend it for 1 year. So investors would require a higher rate of return as you went further out the curve. So that's kind of what the yield curve is. It's what the market is expecting. The current environment is inverted, which is a very unique type of yield curve. It's important to understand what type of environment different segments of the market. So, for example, credit or short, mid, long duration. How do they perform in different yield curve environments? And that's something that investors need to consider when they are looking at the yield curve and how they should position themselves over the short and long term so that they can manage volatility accordingly.
Okay. Now, you just mentioned a moment ago that there's been some concern about the yield curve becoming inverted. So, can you just shed some light on exactly what that means and what it might say about where the economy and the financial markets are headed?
Yeah, absolutely. So, in our current market, we have seen the yield curve invert, and we actually are in a prolonged inversion. I think it is the longest inversion that we've had in history. One step back, what is an inversion of the yield curve? It means that shorter term yields are higher than longer term yields. So the market is anticipating that rates are going to be forced to come down in the future. Again, normally as you lend money out, if you were going to lend money for 30 years, you would want a higher return. The yield curve right now is expecting that rates are going to be forced to come down. There's more short-term risk than long-term risk in terms of yield, and you're seeing an inversion of the yield curve. So what does that mean? So a prolonged inversion is generally a precursor, historically, to a recession, as the market expects that rates are going to be forced to come down, which generally means that growth has slowed and central banks will need to cut rates to stimulate the economy. So, how do you position yourself accordingly? Well, I would look at it and say, how can I take advantage of shorter term rates? Well, that's investing in something like short corporate bonds, reducing my duration exposure, kind of hugging that short end of the curve where we're seeing those higher rates. So you're earning a higher yield for less risk, curve risk or duration risk, but then complementing that with long duration exposure. So remember, we said as rates go down, bond prices go up. So if we expect that inverted yield curve to be true, and we expect that the rates are going to start to come down at some point in the future, you want long duration, like long government exposure, to provide that upside pop. And so that's why I think something like positioning yourself with the barbell allows you to take advantage of the current market with higher short-term rates, but also allows you to take advantage or get some protection from rates cutting in the future. So I would look at doing that barbell strategy.
Okay. Yeah, that's a good explainer on that. That it's very clear now exactly how that works. So thanks for shedding light on that. Let's move on to question number 4 as part of our framework, and this is a buzzword that we've all been hearing about recently, and that's inflation. So how does inflation affect bond funds?
Just from a definition perspective, inflation is the rate of change in the cost of goods and services over time. And in essence, inflation erodes, so not a good thing, the purchasing power of money, meaning a dollar today is worth less tomorrow. We've just experienced a period of high inflation. And for the first time in 30 years, we saw persistent, almost double digit inflation for several months there. And this is what really necessitated the central banks to start rapidly increasing interest rates to cool inflation. In a normal market, you wouldn't see the central banks go from 25 basis points to 500 basis points or 5% in less than a year. But in a period of upside surprises in inflation, like we saw last year, what investors can do is they can look to something called inflation protected securities. These are Canadian real return bonds or US TIPS, TIPS, Treasury Inflation Protected Securities. And what they do is they protect investors from upside surprises in inflation. So they protect your purchasing power. Keep in mind, it is for upward surprises. So while I do think inflation is still topical, we are at a much lower absolute level than we were before. So, in a normal market, investors generally don't need that inflation protection over the long term. So that's something for investors to look at. Where are we in terms of the inflation protection? Do I need to protect myself from upward surprises of inflation? And if you do, inflation protected securities are for you. If you don't, just the plain vanilla bonds would be an alternative.
Okay. Now, Matt, on that question, since they kind of do offer you protection on the upside, let's say you did buy it at that's kind of the peaks and the rates went down, does that adversely affect you for holding these products then?
Well, it shouldn't necessarily adversely affect you in terms of holding tips. What would adversely affect you is if inflation expectations start to come down materially, so you're not seeing upward surprises, you would be better off. It doesn't mean you're going to get pure negative returns, but it means the trade-off. You'd be better off in a non-inflation protected security. So two bonds, one inflation protected, one not, of the U.S. Treasury, let's say. In an environment where inflation expectations are coming down, you are better off without paying the premium of inflation protection. So, for example, it says, in an environment where it's coming down, why pay for insurance if you don't need it? So, it's not it's more of an opportunity cost than anything. But I think in an environment where inflation expectations are coming down, inflation protected securities are less topical in a portfolio context.
All right, the last major question is what type of investing account is the investor using? How might this help shape the decision on which fund to choose?
Yeah, so I think tax is often a primary concern for investors, especially in fixed income. So all things being equal, if you have two accounts, if you could hold the fixed income in your registered account, you can avoid having this conversation about tax. Not everybody can do that though. So if you do have fixed income or bonds in your non-registered account, it's important to understand how bonds are taxed. So the coupon that you earn on bonds are taxed as income. So generally that's the most punitive level, the highest level of tax that you're going to pay. And so in a taxable account, the higher the coupon of a bond, the higher the tax the investor will pay, all things being equal. So bonds trading below par, which I said before, are discount bonds, so they're trading below $100. That generally means, right, the coupon is lower than the prevailing interest rate in the market. The difference between that par value and the current price, that difference can be taxed as capital gains if you hold that bond to maturity. So all things being equal, taxable investors can look at bonds with lower coupons or ETFs that target bonds with lower coupons or discount bonds to get better tax after tax returns. So it's not something, I wouldn't say it's the number one factor that investors look at, but it's something to consider if you are if you have your fixed income allocation in a taxable account. Tax is something that you should just be aware of, be tax aware, understand the implications. And if you can invest in something that like an ETF or a fund that targets only discount bonds, that can lead to better returns over the long term just because you're minimizing that tax impact you have.
Okay. Yeah, those are fantastic considerations to keep in mind for us when we're making those decisions there. Now, final thing I wanted to mention was, let's say an investor uses the decision tree to help them find bond funds that does align with their outlook. In your opinion, how important is it for them to also remain diversified beyond their investment view?
Yeah, so for me, fixed income is not about hitting a home run. It is about safety, income, and downside protection. And I think that needs to be that the stability of your portfolio and not the home run of your portfolio. That's the equity side, that's the growth side. This is about stability, and this is about weathering the storm during volatile markets. And if you look historically and you look at historical returns, fixed income tends to be range bound returns. So many segments of the market are extremely efficient. So in my opinion, being diversified and using something like a core satellite approach is the best way to create better investor outcomes over the long term. So I would consider a low cost passive ETF for that core building block of my portfolio. Then I would use segmented fixed income ETFs like we said earlier, short corporate bonds or long federal bonds to complement that exposure. From there, I would complement my low cost exposure with active management in areas where I see inefficiencies like corporate bonds, high yield bonds, or emerging markets. And I think a core satellite approach using both passive and active should help investors achieve better outcomes that provide that safety, income, and downside protection over the long term.
Okay. Yeah, great thoughts there, and I really like that approach that you mentioned about building that kind of core portfolio and the satellite approach. So there's something food for thought for us when we do get to getting our portfolios built with fixed income. And just a quick note to our audience: you can hear more about how bond funds work and some criteria to consider when researching them in our past webinar. Five factors to consider when choosing a bond fund. It's available in the Learning Center on Webbroker and on TD's YouTube page. All right. Now that we've walked through the bond fund decision tree, let's dive into Webbroker to find out how to research bond funds that might fit an investor's criteria. All right, once you're logged into Webbroker, we're going to head over to our screeners tool. So let's click on the research tab to start with. Under the tools category, we're going to head on to screeners. This is the tool that's going to allow us to filter through the universe of funds and narrow down our search to localize it to those bond funds. So from here, we're going to click on the ETFs tab over here. And within here, we can now start our screening. Now, what I've done is to get us started off, I've already given us a base and filtered some of it out. So let's go over here and I'll show you what we've started us off with, and we'll go add a few more further criteria. So within here, I'm going to click on edit screen for a second because I've already had one that I've saved to from a previous time. So what I've done so far is adding the country criteria, and we've added the fund category. And this is going to be the one that you really want to focus in on, is the fund category. It's found right over here. And you can sift through this list, which is alphabetically organized, and look for all of the ones that are going to be labeled as Canadian fixed income, or if perhaps if you want to look at US based ones, you can as well there. Now I've done all of that and sorted out through a bunch of these. You can see the ones we've been discussing. Here, next thing we're going to add is our index criteria. So what we want to do is, this is going to help us sort between that question we asked about passive versus active. Usually most passive based ETFs are going to track some sort of index. So let's say we want to select that. From here, what we're going to go is head on to portfolio, and I want to choose fund inception. Now, fund inception will allow us, the reason I'm choosing this, I want to see how long that fund has been in existence for, or rather have one that's been in existence for longer so we can track its performance better over a long-term period. Then if we go back up here, the next thing we're going to be doing is heading over to performance and going back to tracking, going to tracking error and adding this criteria. This criteria allows us to see which funds which do track indexes are going to be able to track them more closely than others. And we want the ones that have the lowest to below tracking error. as our criteria. The final thing we're going to add is under the dividends category, we're going to go to distribution. I'm going to choose frequency, not yield. Maybe you can't choose yield if you're looking for specific yield, but here we really want to see those funds that are paying a distribution, of course, and it doesn't usually it'd be monthly or quarterly, and further narrow that list down. You can see the results we have is down to 71. So let's go ahead and click on view matches, and that's going to show us what we have over here now. Now you can sort through different information that you're seeing according to these headers. So let's say we want to sort by fund inception to see which is kind of the oldest one in existence, and you can see that. And if you further sort it, you can see kind of which one recently came into the market space. Also within here, we are able to go to the summary page. And if we look within here, you can sort by assets under management, total assets that they have. But I think for most investors, they'll also want to have a view on the cost, and that's going to be through how much each respective one is MER as well, along with the distribution yield over there. And then from here, what we can do is we can actually go and look at the performance. If you want to see the hard empirical numbers, you can come under performance under the annualized returns. And again, it's sorted right now on a 5-year basis, going from the highest to the lowest total returns that we're looking at. But we can look at it on different metrics. Let's say in the last year, because we've been in this rising interest rate environment, what does that mean for? And so if we look over here, we can see the performance sorted according to that. You do have the ability to do run a comparison as well. So if we wanted to compare certain funds, we can click the respective ones right here. Let's just say I'm going to do 3 to begin with, and then we can hit the compare button. And so from here, we can do a side by side to run some of those numbers against each other to help us make our decision. But we can also go to the top and click on performance chart. And again, you'll see these each respective ETF is color coded by with this bar to give you a legend onto which one it is on the chart. And same thing over here, we can look at on a 1-year basis what the performance has been like, and if we want to look at on a longer time frame, how that has stacked up there. All right, Matt, we're going to have to leave it there. Thanks so much for sharing some of the key questions for investors to consider when researching bond funds. Any final thoughts you'd like to share with our viewers?
No, thanks for having me here. And I know it can be a challenging and daunting part of the market and part of your portfolio, but I think using something like the decision tree will really help investors have confidence in their allocations over the long term.
Yeah, it's a great framework to really think about how to approach bonds, especially someone who's kind of getting their feet wet in that new asset class. So it's a fantastic way to try to get us align that to our portfolio. So once again, thanks so much for joining us, and for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.